Taking a closer look at the financial frenzy, the newly formed Silicon Valley Bridge Bank has a new CEO. That CEO is now urging customers to return because the bank is once again open for business. Federal regulators stepped in and took over on Friday. Here with more is Phillip Shaw, the senior advisor from Goldstone Financial Group. Great to have you with us. Why is it important for investors to remain calm at this time?
One of the biggest reasons to remain calm is to remind yourself that these things pass over time. There's always going to be instability in the market somewhere. And the biggest thing you can do for yourself is to remain diversified and keep your long-term outlook in mind.
What do you suggest for tech investing? Because that bank was so closely tied to what was happening in Silicon Valley and tech companies.
As we've been seeing higher interest rates, my recommendation has been to stay away from the tech names that aren't what you'd call revenue positive. So the smaller technology companies, the new emerging technology companies are going to have a much harder time than your larger, more established tech companies, especially if they have ties to Silicon Valley Bank, especially if they're reliant on new funding. They're going to have a much harder time finding good rates. They might have a hard time finding funding for new operations. And especially as bank lending tightens up, that problem is going to likely become worse and not better.
How can investors find out if they have connections to Silicon Valley Bank?
Unfortunately, that can be a difficult one to find out. A lot of the technology companies, especially based in Silicon Valley, had a high reliance on Silicon Valley Bank. They're not necessarily going to tell you every bank that they have business with, but that is something that you can find in some regulatory reports.
What's your recommendation for investing in startups or even IPOs?
Anytime you're investing into an initial public offering or IPO, especially when it's a new technology company, I would just remind yourself that risk and return are married to each other. And so if you're looking for higher returns, you're going to accept a lot higher risk along with that. Whether it's a good company or not, anytime it's initial public offering, you're taking on a great deal of risk with whether or not they can really fulfill the promises of what they're expecting.
Traders on our show have been telling us that the situation is really just a blip. What are you telling your clients?
For our clients, I agree. I think this is going to be a temporary issue and a blip. I'm very happy to see that the FDIC and the government have stepped in to stem a lot of the issues that we're seeing. I would be careful if you have money with any of the smaller banks. My recommendation is, especially even when it comes to things like CDs, to keep yourself with higher, more capitalized institutions. While they are FDIC insured, that doesn't mean you'll be able to get your money tomorrow, even in the event of a bank collapse.
Thank you for your time and your terrific information.
Thank you very much for having me.